Good morning. This is Neil Polhemus. I will be talking today probably for about 45 minutes on the basic topic of using Statgraphics to predict financial data. In particular, one of the questions we'll be looking at is, will the price of a particular stock go up or down? Now, Statgraphics has in it a lot of facilities for handling financial data. I decided to make that a topic of today's webinar when I saw some financial analysts on TV talking about how Apple computer stock was a good stock to be buying at the moment. I found that a little bit curious because if you take a look at my screen here, you'll see that since the beginning of 2015, Apple hasn't made people too much money. In fact, it was up at around $130 back in the spring of 2015 and is now down closer to 100. It may be a good time to buy. Certainly if the trend of the last week or two continues and the price continues to go up, that would be true. But the overall trend in the last year and a half is not particularly encouraging. So I thought it would be interesting to see what some of the procedures in Statgraphics would say about what's likely to happen to that particular stock. Now, the outline for my talk today, there are three things I'm going to be showing you. I'm going to start by going and fetching the most recent information about Apple and create a high-low, actually an open-high-low-close plot. And we'll put some trading bands on that particular plot and see if, in fact, there are any interesting signals that we can see just looking at the data about what's likely to happen in the short term. I'm then going to take a look at the time series forecasting procedures in Statgraphics and see if perhaps we can just take the historical data on Apple projected into the future and get an idea about what's likely to happen. And then third, I'm going to look at some of the classification methods, in particular a discriminant analysis, to see if I can pick from a group of stocks which are likely to be winners and which are likely to be losers. Okay, so that's the outline for the webinar today. Now, the first thing I'm going to do, as I said, is I'm going to go get the historical prices of Apple common stock. And I'm going to do it by going to our cloud-based product, which is Statgraphics Stratus. The nice thing about Stratus is it has the ability to query real-time, actually Yahoo Finance, and grab the data on any particular ticker symbol. So let me, for the moment, move out of PowerPoint, go over to Stratus. There it is. I'm now in my browser. You get to Stratus, incidentally, by going to www.statpoint.net. And anyone can use Stratus free of charge on small data sets. There are subscriptions you can buy to analyze larger amounts of data. Now, the place to go get the Apple stock would be under File, Query Stock Prices. Okay, you can see that Apple actually comes up by default. You can type any ticker symbol in there though that you want. And I'm going to ask it for about a year's worth of data. So I think I'll tell it to give me all the data starting June 1st, 2015. When I then press execute the query, you'll see it says that it's returned 253 records. That would be the closing prices and other information every day beginning June 1st, 2015. Okay, now if you'd like to see the data, I'll go back to the home screen and bring up the editor. The editor will show me what the data I just obtained looks like. In fact, there are 6 columns in the data sheet that I just downloaded: date, open, high, low, close, volume, and something they call the adjusted close. Okay. Now, in order to analyze the data, I'm going to save it. And I think I'll save it in something called my AAPL data. It'll be saved actually in a standard Statgraphics file. There we go. Then I'll go back to the file menu, tell it I'd like to manage the data files, find my AAPL data, I believe that's the one I just created, and tell it to download it to my computer. Okay, it's now been downloaded to my laptop. You can see it down here, and if I double click on that downloaded file, it'll bring up Statgraphics Centurion, and now I have the data on Apple common stock loaded into Statgraphics Centurion, where I'm going to do my analysis. Okay, let's start by using the Open-High-Low-Close Candlestick Plot statlet. Okay? Statlets are interactive graphs that are very, very interesting for initially examining data. And I'm going to tell it to please put the opening values here, the high values here, the low values here, the close values here. I could plot the volume if I wanted to, but I'm not going to do that. I'll just put in a date and press OK. What you see on the screen now is the Open-High-Low-Close plot. If you've not seen a Open-High-Low-Close candlestick plot, what it's done is it's drawn a little symbol, which supposedly looks like a candlestick, at each day where there was data available, where the stock market was open. And it shows with a central box on each day the open and the close. And it's colored green, the box, if the stock price went up that day, and red if it went down that day. So that's the central part of the candlestick. It also shows with what appear to be little wicks extending above and below that box where the high and the low were for that particular day. Okay. Now, in addition to that, we've plotted some other interesting statistics on the graph. First off, there is a moving average. The blue line in the middle here in my candlestick plot is the moving average. And I can control the width of the moving average up here on the toolbar if I want to. By default, it's set to plot the average of the last 20 days, which seems to be a pretty good setting. On either side, excuse me, on either side of the moving average, you see what are called Bollinger Bands. Now, Bollinger Bands are an interesting way to show the natural trading range in which the data falls. And let me go back to my PowerPoint presentation for just a moment and to show you just a little bit more about Bollinger Bands. In order to compute Bollinger Bands, you start by calculating a moving average. Now that could be a simple moving average, the way we did it here, where you just average the last so many observations, or it could be an exponentially weighted moving average. Bollinger suggested the simple MA, but we put in the EWMA as a choice because it actually smooths all the data going back in history. The second thing you do if you calculate Bollinger Bands is you use the recent data to calculate a standard deviation. The way you calculate the standard deviation is you look at the variation of the data around the moving average, and from that come up with a measure of how much the data have been varying from the moving average in the recent past. You then go ahead and you plot trading bands at plus and minus 2 standard deviations. Okay, so if we go back to Statgraphics and take a look at our plot again, you can see on either side of the moving average those 2 sigma Bollinger Bands. Now, Bollinger says, and there's a very interesting book that he wrote called Bollinger on Bollinger Bands, that you can use these Bollinger Bands as trading signals. And he has various rules about what you might want to do when you might want to buy and sell based upon where the observations fall with respect to the bands. A quick summary of what Bollinger suggests that you do. He suggests that you compute 2 indicators. The first indicator is %B. That is the location within the bands. So you take the difference between the stock price at the current time, subtract the lower band, divide by the distance between the bands. That basically shows you where you are. It would be 0.5 if you're right in the middle of the trading bands, and somewhere between 0 and 1 as long as you're within the bands, although it could actually go outside that range if you went above or below the bands. Secondly, Bollinger suggested that you compute a band width. The band width is the difference between the upper band and the lower band divided by the moving average. What the bandwidth gives you is a measure of volatility, essentially, and recent volatility in that particular measure. Now, if you follow Bollinger's advice, the bandwidth is the most important statistic. And he says you can use the bandwidth for 3 different purposes. First off, it's very good at identifying the squeeze. The squeeze is a situation, and we'll see it on the plot when we go back there in a moment, a situation where you've had very low volatility for some period of time. According to Bollinger, when you see this squeeze, it's a signal that something's about to change. Not necessarily a signal about whether it's going to go up or go down, but a signal at least that something's about to happen. The second thing to look for is a breakout from the trading range. If you see a breakout from the normal trading range followed by a sharp expansion of the bandwidth, Bollinger sees that as a sign of a sustainable trend. And finally, the third thing to look for is changes in the direction that a band is moving. Now, these things are easier to see if we go back to Statgraphics and actually look at the bands. You can see that there are places where the bandwidth is quite small. For example, right here in November of 2015, you see what Bollinger would call the squeeze, and where things have been relatively stable for a while, and as Bollinger suggested, where the squeeze occurs is about the location where something's about to happen. You see another squeeze back here right before a precipitous drop in the stock. You see a squeeze here right before the stock started to climb. Now at the moment, on our last day, which would have been yesterday, the bandwidth was 0.28, relatively wide band. So we're not in a squeeze situation there at the moment. The other thing that's particularly interesting here is places where the lower band starts to turn around. You can see, for example, right here, there was a turnaround in the lower band, which coincided with a pretty good rise in the stock. Okay. Here was a turnaround in the other direction, followed by a fairly sustainable trend in the wrong direction. A turnaround of the lower band here was shortly thereafter followed by an upward trend. And the good news for us right now is last week we saw another turnaround in that band, indicating that perhaps the trend line which we see over the last week or two is going to continue. Now there are no hard and fast rules here, obviously, but if Bollinger suggests, and a lot of people seem to believe, that if you watch these bands and watch the location of the stock with respect to the bands, you can see fairly interesting signals. Now, whether they'll all hold up or not, of course, is something you only find out by trying it yourself. The nice thing from a statistical point of view of the Bollinger Bands, though, is they are showing you the variability, or you might call it volatility, over the recent past. So you do get an idea of where the stock is likely to be. You can also see, of course, some quite unusual outliers back here, for example, where all of a sudden the price went outside the bands. Okay, well, the Bollinger Bands are a good way of showing us what's been happening in a particular stock. If we want to project that stock price into the future, the natural thing to think of doing is to use one of the automated forecasting procedures we have. So I'm going to now take this same data and do some forecasting for you. If I go to the top menu in Centurion and choose Forecast, you'll see that there are two options. There's an option where I, as a user, can specify a particular model, or I can have the program automatically select a model for me. I'm going to go ahead and do the automatic forecasting procedure because that will let the program try lots and lots of models and pick what appears to be the best. Now, what I'll be forecasting will be the closing price of Apple stock versus date. And I'm going to ask it to forecast the next 30 days. That may be somewhat optimistic, but we'll see what it says about what's likely to happen over the next 30 days. Okay, now the automatic forecasting procedure will fit lots of different models if I ask it to. It'll fit random walks, it'll fit trends of various sorts, linear trends, exponential trends. It'll try a moving average. We have various types of exponential smoothers. And we can also fit ARIMA models. ARIMA models are autoregressive integrated moving average models. And we specify here the maximum order of each term in the ARIMA model, the AR term, the MA term, the differencing term. The program will try lots of different ARIMA models, actually, up to a 222 model, because I'm telling it that's the most complicated I want to look at. Meanwhile, in all of the procedures, the exponential smoothers and the trends and so forth, it will also be optimizing the parameters. doing least squares or something similar to that to get the best parameters. Now, in terms of how I want it to pick a model, there are a number of different ways that I can ask it to select amongst the models. The method selection criteria chosen by default is something called the Akaike information criterion. That's basically a penalized likelihood approach. You find a maximum likelihood estimator, but you penalize it for the number of parameters. So the more parameters are in the model, the more that model will be penalized. That Akaike information criterion is a way that we can avoid overfitting, putting too many parameters into the model. And then there are some similar criteria in the Hannon-Quinn criteria, the Schwarz-Bayesian information criterion. Or if you just prefer something like the mean squared error or the mean absolute error, you can ask it to pick the model that will minimize that statistic. Okay. Well, when I press OK, I'll then get to select the different graphs and tables that I desire. I think I can take the default. They look pretty good. Press OK. It'll fit all of the models, and let's see what it decided would be the best model. Wouldn't you know it? It's decided that amongst all those elaborate statistical models, the best model is a random walk. Now, with a random walk, the best forecast of tomorrow's price is today's price. Okay. Basically, there is no relevance of any of the history in terms of being able to predict what's going to happen in the future. And it is amazing, actually, how many times I put stocks through this automatic forecasting procedure and it says random walk. The best forecast for tomorrow will be whatever happens today. Now, it's interesting. I took my first economics course, I don't want to tell you how many years ago it was. But the fellow who was teaching it was a fellow named Bert Malkiel. Professor Malkiel wrote a book, actually, called A Random Walk Down Wall Street, where he explained why there would be so little information in the historical data. Basically that the market acts in such a way that whatever interesting data, information there might have been in the past will already have been acted upon by the time you or I get a chance to actually go ahead and try to forecast things. So in terms of automatic forecasting, REMA models and the rest of that, unfortunately they don't seem to be too useful for forecasting what's going to happen in the stock market. All right, well, let's take a different approach then. Let's see if we can't go back to our PowerPoint slides and try, since the automatic forecasting approach didn't work too well, try doing some classification. Suppose I'm at the point where I'd like to decide what stock to buy. There is lots of information about various stocks that I can find on the internet. In fact, there's a program, a website, which I should probably show you, called finviz.com. I don't know if you've ever been to finviz.com, but it's a very nice website where you can go and get lots of information about any security or company. So for example, I'll go up here and I'll tell it to please search for Apple. Okay, there you go. You can see now the Apple stock. And if I scroll down, you can also see about 69, I believe it's 69 metrics describing what's been happening as of today, or as of yesterday, I believe it probably was, with respect to the Apple stock. You see all kinds of metrics. You see the price-earnings ratio. You see the price-to-earnings-to-growth ratio. You have things like return on assets, return on equity, return on investment. There's an RSI, a relative strength index. There's a beta statistic. There's over here an analyst mean recommendation. Typically analysts will rate these securities as well, and there's a recommendation scale, 1 being buy and 5 being sell. They rate Apple at a 1.8 actually at the moment. Well, what I'd like to do is see if we can't take some stocks and, based upon all those interesting metrics, divide the stocks into two groups. Those that have done well in the past and those that haven't. And the question is, can we use data regarding each company to predict which companies, which stocks belong to which groups? Statgraphics has two procedures that would help to do this. There's a discriminant analysis and there's a Bayesian neural network classifier. Okay, now, turns out, oops, hang on a second, almost went to the wrong place. There's FinViz. I have a friend, a colleague named George Dyson. George used to teach, well, he still does teach various courses in Six Sigma. He did, for a long time, though, work for GE aircraft engines and teach the engineers there all about Six Sigma. Well, George is also interested in following the stock market, and what he did a couple years ago was to follow 19 particular stocks, take the metrics from FinViz every week between July 23rd, 2013 and July 30th, 2014. And George gave me his data and said, why don't you look at this data and tell me, of those 69 indices that FinViz provides, are there indices that would be useful in predicting which stocks would do well? Okay, so what I'm going to do is I'm going to take his 19 stocks, take the metrics on 6/23/2013, and see which of those metrics would predict how well that stock did over the next year. Okay, so I've got 19 stocks. I've got 69 different metrics as of June 23rd, 2013, and I want to see which of those different metrics would predict the best performing stocks over the next approximately 365 days. Now, this was a pretty good period for the stock market. The Dow increased by 12.9% over that year. NASDAQ increased by almost 30%. Okay? And in fact, most of the 19 stocks that George was following did well. In fact, 4 of the 19 stocks increased by more than 40%. Okay, if you compare the price at June 30th, 2014, it was more than 40% above what it was at the beginning of the time period a year ago. So I decided, why don't I try to figure out which of the different metrics, those 69 metrics that FinViz gives you, would have been most useful in picking the big winners. Okay, the big winners are the 4 out of the 19 stocks that increased by more than 40%. Okay? Now, we're going to use as part of our statistical analysis something called a discriminant analysis. Discriminant analysis is used in statistics and pattern recognition and machine learning and in various applications. What it does is it basically takes your metrics, things like price earnings ratio, return on investment, things like that, and builds a linear combination, finding the linear combination that best distinguishes or separates groups. So I'm going to take my stocks. I'm going to create 2 groups, winners and losers. Okay? And I'm going to see which of the different FinViz metrics best separate the data into groups. Okay? It'll be a discriminant analysis. All right, so let's go back to Statgraphics Centurion and do that. And to do that, I'm going to close off what I've been looking at and call up George's data, which I've stored away in a file called FinViz Winners and Losers. Okay, now, here are the 19 stocks that George was following. Apple happened to be one of them, but he also followed Caterpillar and CBS, eBay, GE, Google, Oracle, AT&T, a real variety of stocks in different sectors. Okay? And you can see as you scroll over for those 19 stocks, various metrics. Okay? You see, excuse me, I have to move something around on my screen here. There we go. You see, for example, the price earnings ratio, the PEG, dividends, ROA, ROE, ROI, volatility, earnings, and so forth. Okay, now, what I did at the end of the file here is I also recorded in a new column here what the price was at the end of the time period. There's a column to the left that gives the price at the beginning of the time period in 2013. Here are the prices on 2014. I then computed a percentage increase. You can see, for example, that Apple over that year, its stock increased by 64%, a price of 64%. That was pretty good. I also created a column, I called it winner, which is a 1 if the price went up by more than 40% and a 0 if it did not. And you can see there are 1, 2, 3, 4 winners. The question is, which of these other 69 columns could I use to separate the winners from the non-winners? That's what a discriminant analysis will do for me. Okay. Now, I've also added at the bottom 2 extra rows. I called them AAPL, that's Apple Now, and Facebook Now. What I did is yesterday I went to FinViz and I wrote down things like the price earnings ratio for Apple and Facebook, the PEG for Apple and Facebook, and some other statistics. What we're going to do then is we're going to use the first 19 rows as a training set or a calibration set, right? We're going to build a statistical model picking out the various metrics that are good for separating winners and losers. And then after we do that, we'll apply it to current data on Apple and current data on Facebook to predict whether or not they're likely to be winners over the next year. Okay. Well, to do that, I'm going to go up to the Statgraphics menu to relate classification methods, discriminant analysis. Now, the classification factor is that column winner. It's the column that has zeros and ones. It's what I'm using to divide my winners from my losers. And then I'm going to put in some interesting metrics. Okay. Since I only have 19 stocks, I don't want to go too crazy here. So I decided when I did the analysis that I might try the price-earnings ratio, the price-earnings to growth ratio, the return on assets, return on equity, return on investment. I think I also tried the RSI, and finally the analyst recommendation. Now, if I had more data, it might be reasonable to try more assets. It's hard to get this data, though. FinViz, unfortunately, does not give you historical information on all these metrics. That's why George had to every week go in and write down the different metrics for his stocks, so we'd have some historical data to work with. Okay, but I'll pick 7 metrics and press OK. Now, the analysis options in this discriminant analysis gives me a choice. I can go in and use all of the variables, all 7 metrics, for example, that I put in here, or I can do a forward or backward selection. Forward or backward selection is similar to a stepwise regression, where in the forward case it will bring in the metrics one at a time as long as they add significantly to the fit, or in a backward selection it'll start with everybody but start throwing metrics out if they're not useful. I'll begin, however, with taking all of the variables. And I think I'll ask for an analysis summary, classification functions, a classification table, and a couple plots. Okay? Now, what it did, let's see what it did up here. In the analysis summary, it said that there were 19 cases. Those are the 19 stocks where I had information. They were divided into 2 groups, the winners and non-winners. It created one discriminant function. That's because there were only 2 groups, and it needs only one discriminant function to divide the 2 groups. And it's almost statistically significant at the 5% level. Okay, that p-value there is 0.056. So it would be significant at the 10% level, almost significant at the 5% level. Okay? If I look at, I think I forgot to ask for it, the discriminant function, it'll actually show me what the coefficients are on each of the factors. What's particularly interesting here will be the standardized discriminant function coefficients, because that will adjust for differences in units. Whatever numbers are the greatest, either positive or negative, biggest in magnitude, would be those metrics that are contributing most to the fit. It looks, in fact, that the analyst recommendation is contributing the most to the fit, The PE, the PEG, ROA, ROE, ROI are about all equal in magnitude. RSI has a very small coefficient, so it doesn't appear to be doing much. Now, another thing we want to look at is how good this discriminant function is at predicting winners and losers. In fact, in this case, it correctly predicted 100% of the cases that it tried to analyze. There were 15 non-winners. They were all properly predicted. There were 4 winners. They were all properly predicted. Okay, and down in this big table here, it actually shows you what it predicted with respect to each stock. Now, to make this a little more interesting, I'm going to right-click, go to Tabular Options. One of the things we put into version 17 was the ability to put row labels into any table. And if I ask for row labels to be placed in here, I can now see what the stocks are. Now, there's a couple of interesting things to see in the table. For example, here is Apple. Okay, Apple was a winner, and it was predicted to be a winner. Where it says highest group, that's the highest predicted group. Okay, about over here, it gives an estimate of the probability that Apple would be in that group. So it estimates about a 0.9992% probability that Apple would be a winner. Incidentally, the other winners in this data set are HAL, that's Halliburton, KORS, that's Coors, and Schlumberger, I believe, at SLB. So those 3 stocks were the winners and were predicted by this particular model to have been winners. Now, this model does involve 1, 2, 3, 4, 5, 6, 7 different coefficients and may be a little more complicated than it needs to be. It's usually a good idea, you need to do the same thing in a regression, to see if you can simplify the model. So the next thing I'm actually going to do is go to Analysis Options and ask it, instead of fitting all the variables, to do a forward selection instead. And in fact, when I asked it to do that, it decided that only 2 metrics were really necessary. In ROA, that's return on assets, and analyst recommendations. Those 2 metrics were in fact enough, I believe, if I go down to the classification table, they were enough by themselves to correctly predict all 100 cases, 100% of the stocks in the group. So it looks, based upon that analysis, as if the most interesting factors are the return on investment and also the second one, which was analyst recommendations. Okay, now the last thing I wanted to do was to go ahead and predict with what would happen to Apple over the next year and what would happen to Facebook over the next year. And I had yesterday put in, I thought, all the information I needed. For example, if I go over here, you'll see I've put in the return on investment for Apple and Facebook. The only thing I didn't put in, I believe, was analyst recommendation. I forgot that. But thankfully, I remember what they were. They were 1.8 for Apple. We saw that in FinViz a few moments ago, and it was 1.7 for Facebook. Remember, 1 is best, is a strong buy, 5 is a strong sell. Okay, if I go back now to my discriminant analysis, now that I have all the metrics I need, you see 2 additional rows in my table. 1 for Apple now and 1 for Facebook now. And the highest group for each one of those is a 1, which means a winner. So according to this particular model, the metrics on Apple are good at the moment. In fact, it estimates about a 91% chance that Apple will be a winner. And Facebook is also good, although there's only about a 68% chance that Facebook would be a winner. Okay. Now, is that really going to happen? Who knows? It's always problematic, as you might appreciate, to fit the past and predict the future from the past. To the extent that the future resembles the past, the model may continue to hold and therefore give me good predictions. But when humans are involved, and humans are certainly involved here, there's no doubt that something could be different and happen in the next year that we just don't anticipate. Now, one final thing to see here is a scatter plot. The 2 metrics that are most important out of the set that I analyzed were the return on assets and the analyst recommendation. And you can see here a plot of my 19 stocks, just a scatter plot on a graph defining those 2 metrics. And you can certainly see why return on assets was such a good predictor, at least for these 2 stocks. The return on assets were very much higher than everyone else. So these were predicted to be winners because of the very high ROA. These were predicted to be winners not based upon the ROA, but based upon the analyst's recommendation. That's the mean analyst's recommendation. And you can see that there is pretty much a sharp divide here between the 4 that were successful and the 15 that were not. Okay. Well, I hope you found that interesting. That took about 45 minutes, which is what I was hoping. I'll now take some questions. Incidentally, there is a handout available which you should have a link to that you can download. It's the slides, the PowerPoint slides, so you can go back over some of the graphs and tables more closely. There's also the ability to ask us some questions. And so I'll go back now and see if there are any interesting questions. You can still ask some questions. I'll spend as much time as we need in order to answer the questions. Okay, when do we start? Well, I guess I don't have to answer that one. Dear sir, we are a software reseller. How do we obtain Statgraphics products? Okay, well, just send me a separate email if you would to neil@statgraphics.com. That's just neil@statgraphics.com, and I'll certainly point you in the right direction. Okay, what is the latest version required to do this analysis? To do the Bollinger Bands, where I started, the Open-High-Low-Close plot with the Bollinger Bands, that requires version 17. That's version 17 was when we added this whole set of statlets to do different types of visualization. The discriminant analysis That's a very classic analysis that's been around. I can't even remember what version. Any version you're likely to have will have the discriminant analysis. Certainly 15 and 16 both do. Someone wants to know, is there a Mac version planned? There's no active work on a Mac version. What we expect to do is to recommend to folks that they use Stratus. If I go to www.statpoint.com, Statgraphics, I have to spell it right, statpoint.net, www.statpoint.net, you'll find access to Statgraphics Stratus. Now, Statgraphics Stratus is a cloud-based product. It runs under a control of a browser. So you can use Stratus on a Mac, you can use it on an iPad, you can use it on a smartphone, any device that has a browser. The calculations are actually done back on a server, but the input-output graphs and so forth are done on through your browser. You saw that, well, you didn't see, but there are a number of statlets here in Stratus, including the Open-High-Low-Close Plot. That's available. We do the automatic forecasting using Stratus. I do not believe we have the discriminant analysis in there at the moment. So the discriminant analysis you'd have to do under Centurion, which does require Windows. But the rest of what I showed you is available for a browser, and that would work on a Mac. And we will be, as people use Stratus more and more, bringing more procedures over to run under the internet. Okay, Statgraphics doesn't, there's a question here. Does Statgraphics show a table of residuals and fitted data from ARIMA models? Well, certainly we plot it out. Let me see if that, if it does or not. Let me go ahead and open up I'm just going to open up some data. I believe I have saved here under downloads. There it is, my Apple data. Okay, got the Apple data back. When I went to automatic forecasting and asked it to predict the closing price of the stocks, I asked it to try lots of different models, and there are a number of different tables. There's a residual autocorrelations, partial autocorrelations. There are plots of residuals. Is there a table of residuals? Well, there's a forecast table. That has it. Yep. You ask for a forecast table, it will show you the data, the forecasts, and the residuals. You can also, by pushing this Save Results button, save the residuals back to your data sheet if you want to. So yeah, no, look for the forecast table and you'll find the residuals. Okay. Is there a way to have Statgraphics produce a list of residuals? Okay, I just did that. Were the values in your discriminant analysis as of the beginning of the analysis period? Yes. Okay, I was confused because you said that George collected data every week. He did. However, what I did, the statistics I used when I did the fit were the statistics from the beginning time period. Because I was trying to build a model that would be useful in forecasting the future. So I took basically the statistics from June 2013, put those used those as the basis for the discriminant analysis and used them to try to predict how those stocks would do over the next year, which I knew. But yeah, all those metrics that I had in the table, they were the metrics from the beginning of the time period. All these metrics here. Yeah, they were metrics from June 2013, which I used to try to predict what would happen, the price increase up until June 2014. Yeah, so they were a year old by 2014. Okay, you showed neural networks 2 on one slide for classification. How does it differ from discriminant analysis? The neural network procedure here under classification methods uses an entirely different approach to build its mathematical models. The mathematical models that are built with the discriminant analysis are based upon Fisher's linear discriminant functions. Okay, so they take linear combinations of the input variables in order to classify observations into groups. The neural network classifier is an example of what's called a Bayesian classifier. It tries to predict based on how close other points are in the space of the factors you give it, which group observations are likely to belong to. Okay, so it looks, if you're in a 7-dimensional space, for example, you plot your 19 observations in a 7-dimensional space and look at each stock and see in the vicinity of that stock how many winners and losers there are. And it was too much, I thought, for this webinar to go through all that mathematics. But it does a sort of a modified non-linear density estimation in order to decide which group each observation is most likely to fall into. Now, honestly, I tried it on this data. It didn't work nearly as well as the linear discriminant analysis. That's another reason I decided that in the amount of time that I wouldn't talk about it today. The input is the same, the output is similar, but I decided not to do that. Okay, another question, could logistic regression also be used for classification? Another approach that I could have taken here would have been to fit, logistic regression. Since the winner variable is 0s and 1s, I could have done a linear regression. It won't classify, it won't put each row into a group. It would give you, though, an estimated probability of being a winner. So that could also be another interesting approach. I decided in this case to do the discriminant analysis because I didn't think I'd talked about that in any previous webinars. Okay, what are the main advantages of Statgraphics over Stata, Mathematica, R, and other statistical software? I would clearly suggest that Statgraphics is considerably, number one, easier to use, has a lot more visualization built into it. We have an automatic forecasting procedure that was 1, 2, 3. It picked the best model for me that you won't find in some other procedures. We have the Stat Advisor. The Stat Advisor, you may have noted when we did an analysis, it comes below all the statistical output and gives you an explanation of what's happened. So certainly between ease of use and visualization and the Stat Advisor, you can get a lot done very quickly in Statgraphics that would take considerably longer time using other packages. Okay. Now, I noticed that you also mentioned R. Okay. We are about to come out with a new build of Statgraphics, version 17.2, in which we have done some exciting work with respect to interfacing Statgraphics to R. My next webinar is going to actually talk about that in some detail. For those of you who are here, you're probably hearing that for the first time, but very, very shortly we'll have a formal announcement. Okay, let's see, another question. Show Stratus again, please. Comment on the interdependency probable on the 69 input metrics. Okay. Well, the input matrix I didn't have it in Stratus. I had them here. FinViz winners and losers. I mean, clearly there are a lot of interdependencies amongst these statistics. Best place to actually see some of that might be under relate multiple factors, multiple variable analysis. See, if I take, for example, some of the metrics I've been looking at, PE, PEG, ROA, ROI, ROE, what else did I look at? I looked at RSI and I looked at recommendation. Okay. The nice thing about this is that it gives you a correlation plot. Okay, I don't know if you've seen the correlation plot. This was also new in version 17 though. What it's done is taken my 7 metrics and color-coded cells in the matrix according to the strength of the correlation between those metrics. So where you see these reds and oranges, that's ROA, ROE, ROI. They're all highly correlated with each other. There's some fairly strong negative correlations as well. Something like ROA appears to be negatively correlated with recommendation. That actually makes sense because buy is small. Buy is a 1 on the recommendation. So you'd expect a low number on recommendation if you had a good ROA. So yes, there are certainly a lot of correlations amongst these various metrics. You can probably come up with a very similar model using, for example, ROI as using ROA. The stepwise approach picked what it thought was the best, so that's the one we went with. But certainly, yeah, there are definitely some significant correlations amongst all those 69 metrics. Now, incidentally, I had tried a bunch of other metrics, and I did not find any other metrics. I mean, I did not do a systematic search, but of the ones I thought might be interesting, the other metrics, I didn't find much. The ones that I found were the ROA and the recommendation. Okay, someone here suggests that if you want to run Statgraphics on a Mac, you should just run Windows on the Mac. That there are a lot of programs and utilities for a dual boot. That is true. Okay, Statgraphics will run on a Mac if you are running a Windows emulation. Okay. All right. Do you save this webinar? Yes. Okay, we are recording this webinar. We will publish it before the end of the day at statgraphics.com. Just go and look for webinars, and you'll see it. Okay. When will the next webinar be? I'm not sure. It's going to be fairly soon, though. Again, I want to talk about what we've put into the next build, the 17.2 build. So as soon as we decide that that's ready to go, as soon as it finishes its QA, I will schedule a webinar. So I would not be surprised to see it within a couple weeks. No promises, but that's what I'm looking at right now. Will Statgraphics in the future become a SaaS program? Okay, well, Stratus is running currently under the cloud. Whether we bring everything in Centurion over to that browser-based program, that has not been decided. I want to see just how popular the cloud-based application becomes. The more people start to use it and want to use it, the more that we'll move over. Okay. Well, that appears to be all the questions that have been submitted so far. So I thank you all for your time. Again, my email is neil@statpoint.com or statgraphics.com, either one, neil@statgraphics.com or statpoint.com. If you have any particular questions that you think of later, I'll be happy to answer those. Have a great day.